welcome to our webinar today. We're giving everybody another minute or so to get into here before we officially start. We're going to talk about investment analysis, some important things to consider. You're going to learn some. We'll do a case study, and I hope to leave a decent amount of time for questions. So think of your questions, ask them as we go, ask them at the end. Just don't wait too long because a lot of times if it goes for a silence at the end for too long, I will shut her down and give you your time back. So when you think of the questions, throw them out to me. So go ahead and take a look at our disclosures. It's especially important for firms like ours when it's investment or planning related. Whenever we do something like this, remember it is for information and educational purposes only. None of this is investment advice. Things need to be personalized for you. You need to look things up to make sure that you're not just solely relying on us to make these, because I spend a lot of time making these presentations, but it's a lot of back work, and I try to make them very up to date, but there's not a ton of redrafting all the information. So generally we believe it to be right, but you need to double check and then check with your advisor, attorney, CPA, tax professional, whoever you use before you implement anything. So again, let's go ahead and officially get started here. Welcome everybody. We are going to talk about an important subject. I think you're going to get a lot out of it. Again, if you think of questions as we start going through in this, then throw them into the chat, and I'll try to hit them as we go, or at least they'll be queued up for the end so that we don't have to just end early if we do. I tried to leave a little bit of time on this one for questions because I think it's going to be a very good one for that. So again, I already gave you my disclosure. I will give it to you again at the end. So we're going to pass on through here. And so again, welcome. I did throw a file up there for you, but just don't get distracted by it. Pay attention. We'll get to that when we get to the case study. But I did want you to have kind of a high resolution version of that, just in case. We've had a couple of people in the past say that some things are blurry, and we've been trying to make that better. But this gives me an out if the screen share is not coming through as high resolution as I would like. So, the first thing as we're talking over our objectives is just kind of rethinking the conventional and looking at some scenarios of how people end up with the investments that they have, and what may be good or bad about that, and what you should consider in possibly restructuring that. One of the things that I don't think many of us like to admit is that humans don't generally fail because we're dumb, and especially with AI now, you can probably supplement most of your knowledge or information inadequacies, but behavioral pitfalls are one of the biggest downsides for humans with investing, because there are just multiple things that we do. We'll go over 4 kind of most important to kind of hamstring ourselves. And I mean, you could do good for 95% of your entire life and fall victim to one of these and really mess up a lot of decades of work. Okay, so when they talk about the average investor, depending on the time frame you're looking at, underperforms the markets by like 1 to 5% per year. Depends on the time frame and when the study was conducted, but it's significant. They didn't do that bad every year after year after year. It's usually they did pretty well, and then at one point made a huge mistake, like getting out of the market in the 2008 downturn, or going and being too speculative during the tech bust and getting blown up. So we will talk about some of these things. And so building off of that, you need to build your portfolio or your investment strategy for resilience, as well as just trying to make money, or going the opposite way in fear of losing money, right? There are lots of risks that you have to take into account, not just market risk, which is kind of the short term up and down. And that's the main risk that people think there are when you invest, is just market risk. So continuing on here. So let's talk about the typical investment journey for most people that aren't professionals. Generally, at some point in your life, you have or are about to, start a job, make some money. You're gonna get from people like me and maybe the AI and your friends and your parents telling you should save, you need to save something, right? And so you get a job and you enroll in the 401k plans. They're being better about it these days and doing auto enrollment at a good percentage. Usually it's 4 to 6% of your pay going in automatically and going into a default investment option, which a lot of times is a target date fund inside of there. So it'll say like 2045 or something like that, right? And then you may change jobs, right? And so then you get a second one or a third one, or you say I read or saw this and Dave Ramsey told me I should start a Roth IRA, or whoever it was, Susie Orman, your best friend, your coworker, and then you start another account. Oh, you saw this thing on Instagram, and so then you started a Robinhood account. So you end up with these different investments, and they build up over time. Hopefully, you don't just rob them continually throughout time, and you start to get this hodgepodge of almost a junk drawer type of amalgamation of these investments that you made over time. And rarely do people like look at that holistically and say, what is my investment strategy? Do I have an investment strategy? How does this investment work with that investment? When am I going to use this money? Is this the right investment, even though it might be a really good one to do for me needing to use the money in a couple of years, right? And so if you don't match those things up and look at it as a whole system, then absolutely is very possible that even with good investments, that you could have a bad outcome, or you could have bad investments and just luckily like hit something good and you think you're good, and you're going to take the wrong lesson from that later on could really hamstring you. Okay. So just like I said, that analogy that I use is like the junk drawer in here. It's probably not as messy as I feel like it should be for what I'm talking about. But I do love to let the AI make the pictures. I should have gone back and forth with a little bit more. But let's think about this just in terms of what's happened more recently. So, especially now, you'll see a lot of people with a lot of overlapping type of investments or funds to where they're owning a lot of the same things in different ones. And I'm like, well, I own 10 different funds. And it's just like, well, you've got the Vanguard Total Stock Market Index, and you've got SPY, S&P 500 fund, and you've got this large growth fund. Like a lot of the companies that you're going to own underlying in there, especially if it's market weighted, where the bigger it is, the bigger piece or percentage of that fund it has, you're going to end up where those things are overlapping and you're concentrating a lot more than you thought you were in certain investments, even though you may think you have a lot. Especially the last 10 to 15 years. I mean, the large US technology companies have just about destroyed everything else. So that's that magnificent seven, the big kind of word that everybody throws out there that all the media and everything likes to continue to talk about, have concentrated a lot. And so there's another thing that will tend to happen as well too. So again, if you have questions, pop them in there as we go. Target date funds in your 401k, mixed with you owning some of those things that I had aforementioned, or you just straight up bought some Apple or Google or Nvidia or whatever you did, can be layering on. A lot of target date funds are very heavy in large US companies and could be almost like a large cap fund. And so again, they could be layering on top of each other, almost being the same thing. And then of course, like we had mentioned before, most of us are going to work for multiple people before we retire versus maybe our parents or our parents' parents, grandparents that worked for one place, got a pension, did 35 years or 30 years as a teacher, 25 as a policeman or firefighter, and they just worked for the same thing all the way through. And a lot of time on the pensions, there was not as much to do in terms of picking investments. They do it for you. Then you just put in an application and get a paycheck from, OPERS or teacher's retirement system for the rest of your life. And then people tend to mix in the hot tip type things. So if you own any like ARK or Apple or Nvidia, as we had mentioned, or you're like, oh, I bought that Bitcoin ETF as soon as it came out. People are just kind of buying the things that are the hottest thing. And generally, when there hasn't been a big downturn or lots of things have gone against it, you'll get a period. I mean, it's been, probably, 2008, 2009, since there was a really big downturn. right? So that's a long time. That's like 16 years before or since people have been wiped out. Because there's a lot of people that are doing these speculative things, or you use a margin. That's where you borrow money to kind of double down on your bets, or they're using their emergency savings to put into their investment fund. And when you have a big downturn that's just not going to be fast, it'll knock a lot of people out. And so, again, this is another one of those things that can really, if you've done well, it can turn around on you real fast and knock out a decade or two's worth of work, okay, or investment. So let's talk about some of those things that we mentioned before. Some of these human biases, heuristics, as they're called. You can Google it, and there are a ton, a ton. And I think I went through this in more depth a couple months ago in one of our other webinars. But I'm going to pick out just 4 here, okay? And a lot of these things aren't very strong, because if our brains had to be analytical and solve everything to make a decision just logically, we would hardly make any decisions. And it's very super energy intensive. And so we've got all these shortcuts. So we've got emotions that help us shortcut, and we've got these biases and heuristics that help our brains and us as well too. And in a lot of circumstances, they serve us well. But in some, especially more modern things like investing, they do not serve us very well most of the time. So recency bias. So recency bias basically is what it sounds like. It's like things that have happened to you not that long ago stand out a lot more in your brain and seem more plausible or probable, right? And even when we look at this now, like I said, large growth or tech has done so well over the last 10 to 15 years. And you're like, man, 10 years is a long term. 10 years might be a long term to you, but to a big system, it may not be. Some market cycles are 10 to 20 years, even 25 years, right? It may not flip over. And you may be biased saying, hey, this is the new thing. This is how things are now. It's been happening this way for 5 years, and they keep saying it's not, and it does again. So there you go. You're falling victim to that recency bias, to just think that things that you've experienced lately, even if that lately is 5 to 10 years, is what's going to continue to happen. Loss aversion. Humans, even animals, loss hurts us more than winning, or the good makes us feel good. Right. And so from that, even if it's subconsciously, but most people will do it overtly and subconsciously, will work very hard to avoid loss. Okay. And a lot of times to our detriment. Sometimes it pays to take a calculated risk, or when you're looking at it kind of statistically, of, possibly hitting that loss if the gains are good enough statistically, okay? But we try to avoid that loss because it just hits it. We feel it more, even if they were equal, okay? The equal up for the equal down. Overconfidence, it's another one of those things. Overconfidence and attribution error, when you think that you know better than other people, okay? That's basically the overconfidence bias, is that it's other people that make all the stupid mistakes. There's something intrinsically superior about me. I'm first person in my story, and so I'm going to get it right, even though they show all these statistics of people picking stocks, almost statistically, right? We got our tails, but almost never being able to beat the markets on a risk adjusted basis. Even the pros generally cannot do that, and they fall out to the normal distribution. And so that is a classic one right there. And I'm sure most of the people on here have fallen victim to that, or continually do. Okay, attribution error is when you attribute good things happening to how awesome you are. It's my easy way of explaining it. And when bad things happen to you, it's because of something external, like, oh, the economy was just bad, or it was the teacher or the school, they just changed this and that's why I failed, And so we externalize bad things, we internalize good things. Again, a very bad way to grow. And performance chasing. This is classic. Lots of people do it. You see it all the time. And even the fund companies and your 401k, when you look at it, when you go look at the investments inside there, if you were going to do some due diligence, or you have, what do? You go and look at the fund, and you probably look at the 1, 3, 5, and 10 year, right? That's what you're going to look at. But really, like I said, some market cycles, trends, or momentum things that are going do not reset within that time period. You are in a long one right now. You are in a long one that's been going, about 13 or 14 years into large growth. And before that, for almost entire 100 years before that, when you look at a 10-year or longer period, large growth tends to be one of the slower like investment internal rate of return versus like small companies and value and other things that you could invest in equity wise. But now it's just smoking everything else. So if you just go look at those performance charts and you say, well, I'm not going to worry about the short term, I'm only going to look at the 5 and the 10 year, it's still possibly, because nobody knows the future, but probably incorrect assumptions you're going to draw from that performance analysis of just looking at 5 and 10 year without anything else. Okay. So again, throw your questions if you got them into there. Let's keep moving on. Of course, there are lots of other biases and heuristics, but you can't focus on that all day. And those are some good ones to focus on when you are taking care of your investments and thinking about yourself to be better at being able to do that. And then you say, well, I've got a financial advisor, or I'm in a fund and they're going to take care of everything. And you know what? There's some really good people out there. I'd like to think that we're very good at what we do, etc. Sometimes professional advice can make it worse. And that has to do with them wanting to win and also the conflicts of interest they may have. So there's lots of conflicts of interest in lots of industries and areas. And there is in the advisory world. But if we're talking about investments, investment managers and advisors that manage money for their people are often evaluated on short-term performance. So the 3 to 5 year, that's a tough one. I mean, 10 years, a lot of times, if it's not too long of a cycle, you kind of get that reversion to mean or things getting back to averages, and it's not as hard as it is now. But that 3 to 5 year period, if you're really lagging behind and people aren't going to give you money, you're not going to get fund flows, you're probably going to get the axe, right? And so you'll get a lot of managers that can be chasing returns, just like we talked about before, because they want to win. They want to get those flows. That's how they make more money, okay? And that can be a bad thing, because what are you supposed to do? You're supposed to buy low and sell high. If someone is return chasing or they're going after the things that have done good, then generally they're buying high. Right now, again, things could keep going up into infinity. But again, if you start chasing those returns, if you're kind of jumping on the bandwagon for shorter midterm type things, then you do very much run that risk of buying high, which lowers your probability of a better long-term rate of return. Okay. And then, of course, investment managers, when they're judged generally, are benchmarked against their peers, not against what your goals are for when you need to use your money or what your risk tolerance is. So how much you're willing to ride the roller coaster to accomplish your goals, or what time horizon would get, the longer term to a high probability of risk. And that's tough. Just kind of like I said, if you compare all the funds in your 401k, the large growth or the ones that say technology or something like that are going to pretty much be anything else inside of there. Okay. And if you're comparing that large growth fund to that small company fund, those are not apples to apples. And with the metrics that they probably give you inside of there, it would just look like you're a moron to invest in the small companies. But small companies may actually be a really good deal right now. Okay. And then, of course, they want to be good at what they do. And so, they're more about, a lot of them, about driving their profession and getting to where they want to go, maybe than just doing good on the investment strategy that you want. And then this is a big one, and it is a problem because people need data. They should have data, right? But marketing materials, they want to show people that they're doing good with their investments so that they don't fire them, right? They want to win. They want you to think that they're doing good for you, whether it's, Fidelity with your 401k or American funds with your kids' college 529. And so they want to put themselves in the best light that they can. And so if they are return chasing and then they put it in marketing materials, they could very well, the things out there that's convincing you to buy an investment because its returns look good could very well be setting you up for failure, right? I was just talking with one of my marketing people just this morning that they're like, well, we could do investment analysis and show you. I'm like, well, listen, a lot of times if you're building portfolios to not just look good in back testing, you didn't just figure out after the fact what was the best stuff and then put that in a portfolio to show them, and you're thinking about the future and you've bought a lot of the stuff that you've done due diligence, that's probably a good deal right now. And if it's a good deal, that probably means in some interval of time, 1, 3, or 5 years, it's underperformed in the past to be the thing that's a good deal right now. If you just show that versus someone that is in a portfolio where they've just bought the stuff that has the high rate of return now, and then you back test on that, you just kind of look like a buffoon. So you can kind of see, if you flip that opposite to where they made their current portfolios to just look good, what happened in the past, they could very much be setting you up for failure. It's why the SEC and stuff says if they want to advertise that way, they really have to have all these disclosures. And of course, you've heard the one, past performance is no indicator of future returns or performance or what's out. And that is so absolutely true. Okay. And people that look really good in the past, there's actually a greater probability that they'll underperform in the future than they will continue to outperform, right? Because you're going to have that reversion to the mean or getting back to averages. Okay. So let me see. I've got a question in here. Let's check it out. Okay. How can you think about investments that could outperform in the next market cycle? Is it best to generally diversify or try to tilt towards areas that may be currently underperforming? So we're going to get into this, and it's going to help you understand as well when I do the case studies, because it's very easy to make blanket statements, to say, oh, just buy the stuff that's down now. Well, yes and no. I mean, if something is undervalued and it's a good investment and it's got just as good a probability of doing well as the thing that's overvalued, then for sure, that's a good metric, right? But there are so many other variables that you have to be careful that you don't want to buy a bad investment just because it's cheaper, right? You want to buy a good investment that's on sale, right? That's what Warren Buffett always says, right? It's like he likes to buy good companies, but he says you got to get them for the right price. Don't overpay for them, right? And it's the same thing even if you're going to buy a whole category of like small value or mid growth or international developed small caps, right? You gotta make sure. And again, sometimes you build systems versus just trying to time the market. And timing the market means kind of the first part of your question to just say, all right, this is this market cycle. Next cycle is going to be this. You don't know that. You do not know what the next cycle is going to be. Is it going to be AI taking off and technology does awesome? Or is it going to be AI taking off and it destroys a lot of the old technology and becomes so cheap that they can't even monetize it? And China makes these cheap chips and then AI starts making its own chips and nobody makes money off of it. I mean, that's kind of crazy. But again, you could have the energy industry take off to the moon because of some breakthrough with fusion power or a mixture between solar and fusion, and nobody even saw that coming. Just like we've been saying AI was going to come for 70 years, and it only did the last 2 or 3, right? So it's very difficult to know what the next thing will be. I mean, you could have huge antitrust and technological decentralization to where it just hammers these large tech companies, but these small startups, because of AI helping them and governments going after the monopolies, do awesome. You can really change around. So really you have to build a system that puts your eggs in different baskets and then try hard to make sure that you do the due diligence, that they're good investments, and then buy low and sell high per what your objective is for that specific pot of money. And it can be different for different pots of money that you have. Okay. All right. So, I already started to talk about this. Be careful about past performance. Okay. So, again, we like data, we like variables, we need facts to be able to make decisions or better decisions, right? But some data, especially by itself, can really lead you into poor decisions. And so, recent winners, and I have to double down on this as well too, because this is such a long trend, right? I mean, I've been in the industry. I just got back from an investment conference last week, talking to a lot of the thought leaders and managers and Morningstar in Chicago. And for a long time, people have been saying, this is going to flip around, growth is going to stumble, value is going to come back, small companies are going to come back. And it hasn't, I mean, they've been saying this for like 6 or 7 years. And the momentum has just continued to go with the large growth tech companies. And so there's a lot of people right now that are concentrated in that. If you got like S&P 500 fund or QQQ or like NASDAQ type stuff or a large growth or a technology centered type fund, you really killed it. And then it's just happened year after year after year. A lot of times people will get in when it's towards the end. But there's been a lot of people that have, so even if they got in like 4 years ago and the trend had been going for 6, that's 4 years of just making money that's validated that they're right. But that doesn't mean that it's not still going to stumble and reverse a lot of that for people, right? And then that's where you always get in different times in the past, you're saying, oh, it's rigged. It's like, you can't win. Is they get in crypto right before it fell 90%. Because they bought it when everybody else was talking about it on social media with their Visa card online. Like, that's crazy, But anyways, just because it's been winning lately and this trend has gone longer than most doesn't mean that it's going to continue. And a lot of people do not even realize how concentrated they are. The example I'm going to give you is a great portfolio that I see derivatives of over and over again, and you'll be able to see how concentrated it is, but how well it's done the last 10 years. Cherry pick back tests. I mean, a lot of professionals are really bad about this, is they'll just pick funds that they're putting their clients into that have done phenomenally well the last 5 to 10 years, so that when I show you like some of the reports I'm going to show you, it looks stupendous. But did they have that the whole last 10 years? No way. Same thing sometimes when we do investment analysis, and we're going to offer to you, we do complimentary investment analysis for people, so that we can help you kind of get a look at some of these things. And what's in it for us is every once in a while people want some help and they'll join us. And so we help people like do a pretty good analysis on how they're already invested, and we'll put that up there as an offer so you can see it now and later. But again, a lot of clients that are just DIY are like that because they have just been looking at the 3, 5, and 10. And like I'd said, for the last 10 to 15 years, the same thing has just continued to do good year after year after year, almost for every year. And so they picked that up. So when we test a lot of their portfolios right now, it looks phenomenal. But they didn't hold it the whole last 10 years or so. They just got in the last couple to 3 or 4. And then, of course, if things flip around, it'll wipe out a lot of what they've gotten ahead by kind of jumping on the bandwagon, right? And then uncertain future. So again, things are changing faster than ever with how technological progress is picking up, and it will continue to change. And I tell people, I mean, this was from a long time ago, famous investor, Sir John Templeton. This is probably one of the most wise investment things that you can really internalize. Internalize it. Is the 4 most dangerous words in investing are, this time it's different, or the one I hear all the time, it's different this time. That's what people say. Oh, well, technology changed all that. It's not going to be like this anymore. Mark my words. In terms of the system of investing and the compound power of earning interest and money compounding is exponential. Technology and human progress has to progress exponentially for investing to continue to work. So it takes that into account already. And it's not different this time. It's not going to be the same as the same history, but in terms of different sectors, different industry leaders, different companies, changing off leadership, it it's not different. Okay. So again, I know there's a thing on here to ask to speak. We just don't do that during these because it's recorded, and these are timed to be on time. So you can put your questions in as questions, but again, I'm the only one that will speak during here. The recording will be shared, um, and it will become on demand. So people can watch it on demand. You just give us your information. You can watch it on demand. You guys already have. You'll get the recording. And then usually a month or so after it gets a little older, then we plop it over to YouTube as well too. Okay. So let's keep going on. So how should you build a portfolio? And when we talk about generally, one of the most accepted things scientifically, statistically, it's called modern portfolio theory. And modern portfolio theory basically is, if we want to simplify it, diversification. Okay, so putting your eggs in different baskets to kind of hedge your bets to try to find that optimal line between risk to reward. Okay, because you get paid more than what we call a risk-free premium, which would be like, what could you put your money in that it's not at risk, right? So like a very high quality treasury bond, or for most regular people, just putting it in the bank where it's FDIC, where the government guarantees it, would be one of the safest things, right? So you get paid above that because you take risk. At least that's the theory. Generally, if you're smart, that's how you're thinking about it. And so the amount you get paid should be pretty consonant with the amount of risk that you take. Now, again, not all humans are very efficient at this. And so modern portfolio theory helps to try to find that balance in between the risk to reward, depending on like how much risk you want to take. Okay. And so the reason you diversify is because you want these things to go up and down at different times inside your portfolio. So that's correlation. Okay. So correlation, the easiest example over time has been like, well, when my stocks go down because of a recession and people fly to quality or safer things, then the bonds go up. Not always, but that is a good example of understanding like a negative correlation is one going down and one going up. And if we mix those together to where they go up and down at different times and we buy low and sell high, we can approach almost getting a very similar return to a more aggressive portfolio for less risk. And then depending on how you need to use your money, you can stabilize being able to take from different parts of your money during different market cycles or different trends, etc. Okay. And so, just like I said, risk and return are not separate. They should be evaluated together if you're really going to build an optimized portfolio. Okay. So I like this, and this is another good quote to remember. It's like a portfolio is not a scoreboard. It is a system you build to accomplish your goals and to navigate once you can swallow your hubris and say, I cannot predict the future. Everybody's got their opinions about it, and we're very susceptible to hindsight bias to be like, after it happens, like, I knew that was going to happen. I knew it was going to happen, but you didn't. And you thought it might. You probably considered it along with like 10 other scenarios that could happen. But most people are not necessarily putting their money where their mouth is. And if they are, you got a 1 out of 10 chance or whatever it is that you actually predicted it exactly right, which is not a good, formula for success. And so you got to, at a certain point, say, how can I build something that is going to do well for me in lots of different scenarios? It's resilient. That's one of the main words I like to use when we're building investment strategies for people is, we don't build the sexiest stuff in terms of like the best thing for what's going on in the world right now, even though it's kind of sexy to me, to build a system that's resilient and that's awesome and that has a high probability of accomplishing our client's specific goal or goals, depending on what we're doing. So how do you do that? Okay. So we look at that and we're looking at building these resilient portfolios. We need to, as we said, get diversification. And right now, especially, I mean, it's flipped back a lot, but people had abandoned a lot of international investments and they just really flooded into US equities. And especially if you're in the US, really concentrated. I mean, most people are over 80% concentrated large US now, which is wild. When there's a whole other world out there, and we're maybe 50%, 60% of the world, and of course, market cap by stocks, we're a little bit more. But when you look at GDP, we continue to go down, down, down. The rest of the world is growing. They got to catch up to the developed world, and what so. So, it's probable that a lot of these countries are going to grow faster, and then they have different. They have different business cycles. I mean, a lot of times we've been starting to go up and down. We have global recessions instead of just a recession in the United States, but still, some of them will be in a total different cycle as us. We could be going through a recession, and China was going to go with us, but then the Chinese government decided to stimulate, and they actually have a decent amount of growth when we're going down. That's a great thing to have. Again, we want to have, when one thing's going down, another one going up. I mean, that's the best, to have negative correlation. But a lot of times, just low correlation is good in today's world. So we need that international. If you look at like what's happened, kind of when we look at the year to date, large companies are up about 5%, but international's up, depending on what you're investing in, like 15 to 30%. Right. And so, buying low and selling high in this, like where you can see there in this circumstance, worked out pretty well. Style balance. So, I've talked about it a couple of times, like growth and value. So value is kind of the more Warren Buffett, which is kind of like, hey, let's buy good companies and get them on sale. And you go deep value, and then some people would argue some of those are not necessarily good companies. They're just super duper on sale. And if they make it in any way, shape, or form, you're going to get a bounce back, but they could go out of business. That would be like hardcore to the value side. Then growth is, and again, there's different continuum of growth, but the more extreme is just like, I don't care how much it costs. I just want to buy the best companies that are going to grow the most, even if I have to overpay for them. Okay, so that's kind of the extreme of growth to value. So style balance, you want to have some of both. Like I said, over the long term, when we look at longer term periods of time, values tended to beat growth. However, we look at the last 10 to 15 years, and growth has just kind of stomped value, by almost 5% per year. And so it's a significant difference. But you can see that's good to hedge your bets. I wouldn't want to be all one and be underperforming, by right now, I mean, like probably the worst is like emerging markets as an equity to large growth. And it could be like over the last somewhere in 10 to 15 years, it could be like 10 to 12% per year over that entire time period. That's huge. But that doesn't mean that emerging markets aren't going to do well. They might be the thing that does best the next 10 years. We don't know. We do not know the future on that. Okay, let's see. It says, to what extent we should got a question. To what extent should we shouldn't we rely on past performance? So it absolutely is a variable. You can't ignore it. It's a very important variable. So if you're looking at a manager, like an active manager that's making calls on a certain sector or area they said that they are going to focus on. Let's say it's small companies in the United States that are value oriented. That's a pretty specific area that manager is going to focus. And you look at the rate of return, and it's a good bit lower than most of its peers. Now, what are its peers? Is its peers all the small companies? Well, it's not very fair to put small value against a small growth manager. I mean, it's a absolutely, you can do that analysis, and it has important information, but that shouldn't be the comparison in terms of, is this a good manager, right? If you compared it just against the index funds, but the index funds are a lot more growth oriented now versus value, it may not necessarily be a good indicator. But if you're comparing apples to apples to apples, it may be a very good comparison when you're just comparing in that category. Okay, but you got to look at the other things inside of there. I know some good managers that have had bad time frames, and a lot of times they have more concentrated positions, and they're in a long hold type strategy. They're like, I know this company is going to come and do awesome as soon as this and this hit, or eventually once people wake up and realize it. And they may underperform for 5 years, and then all of a sudden be in the top quartile and make back with. So you have to evaluate. If it's an index fund, it's a lot easier, right? Because they should be pretty dang close to other index funds and or the benchmark because there's no judgment call going on in there. And then you'd want to see how expensive is it, relatively. So again, there are a lot of different variables to look at. But if you evaluate it and, hey, like this is good in this category, this is a good manager, or whatever the case, and it's just down compared to other things, then I wouldn't look at performance as like, oh, it didn't do as good as mid growth, I'm not buying it. It might be like, hey, this did in the top quartile for its category. I love this manager, the strategy. I got it for a reasonable price. It's almost the antithesis of I'm getting something great for a good price. So like the performance of it is actually kind of reversed versus the entire universe of investments. But again, you got to look at it in context of things. Another question, overall, from your perspective to investment analysis, what are the key elements one should go for and prepare a blasting portfolio? So again, this is one of the reasons why it's tougher for us to do stuff like this, because as an investment advisor, we can't tell you exactly how to build your portfolio because there's so many permutations of what different people are trying to accomplish at different points in their life based on who they are and how much risk they could take. Because if I built somebody an awesome, almost speculative portfolio and you put like digital assets in it and growth stock and, you could even buy some private stuff, that's not appropriate for the vast majority of people, but it could kill in performance a lot of other things, even on a risk-adjusted basis, right? But a lot of people would use that and blow themselves up. And so we can't give people specific investment advice like, what should I do? What you should do for you is you have to figure out how much risk you're willing to take. How long is that money going to be there? And then that's going to dictate what's the investment universe that you draw from that would work in that. And sometimes an individual investment may not work, but when you combine it with two or three other, like we said, with like the diversification and non-correlation, and you're going to like rebalance to buy low and sell high or take money off the table, depending on your actual implementation strategy beyond just the investments that you buy, it could absolutely be appropriate for you. It may not, So in that respect, I would say you have to build a system that will work for what you want, for who you are, and how fast you need to use that money. Okay. And I'm going to give you a specific example. I'm not trying to hide things from you, but I don't want somebody to take this and then it hurt you, So continuing to drive on asset class parity. Really, it's so tempting to just want to put stocks and, things that have done really well, gold or crypto lately, and just say, I'm not doing bonds, or what the heck is cash for anyways, or even other, types of investments that may be less used, like art and firearms and commodities and different things like that. But we need to consider them and how they work when you're in a really high growth economic state like we are now. What happens if there's a global recession? What happens if there's just a US recession? Everybody else is doing good. What happens if there's significant inflation or stagflation, or God forbid, a bad deflation, like what happened in the Depression? Heck, we could have something that's never really happened before, which is a good deflation if technology really increased productivity and decreased costs so much, but there was still prosperity, right? All right, I'm going to spend a little bit too long here. I want to keep moving on. I'm not going to hit too long into these. You can look these things up if you want to get into them. There are certain more sophisticated, as people have asked, variables that you can look at, internal rate of return. We also call this one money-weighted rate of return. It tells you how well you did on your specific investment or account based on when you put money in there and took money out. Okay, so how was your timing basically of when you were putting it in and how you were using it? Because that has a big effect. Like we show this for all of our clients. They can see it both ways. Most investment firms do not provide the difference. Time weighted is just saying how well did the investments that I have do regardless of when I put money in or took it out. So it's like how good was the investment regardless of how I used it. Okay, it's a simpler way to say it. Standard deviation is a very good metric for kind of how risky something is in terms of how much is it going to bounce around. Beta is how aggressive is it compared to the market, right? So if you're, a 1 compared to the S&P 500, it's going to move around as widely as the S&P could. If it's 0.5, it's half. If you're in something super aggressive, it might be 1.5, and it moves around 50% more than the main US stock market. Alpha, how much did you earn beyond what's expected? We use this a lot in our industry. It's kind of jargony, but we talk about alpha as like when we build portfolios and help people either reduce risk or increase gain, risk adjusted return. We use it on like taxes. We provide tax alpha to people, like getting them money that they put back in their pocket from the tax work that we do for them, or tax loss harvesting, and getting into certain planning or charitable strategies that help them. And then it can get more complicated into R squared and Sharpe ratio. Since I'm getting shorter on time, I'm not going to dig deep into those. So let's look at my example here. All right. And so this is a hypothetical portfolio, just because I just kind of did an amalgamation of things that I see commonly. Okay. And this is a pretty good report that Morningstar puts out. It's the one that I put in here in the files that's available to you. And basically, when you look at it, I'm just going to scroll down here so that you can see. I have a better one than this. Oh, yeah, there it is. You can kind of see it's kind of that hodgepodge of stuff that people may have collected over the last 10 years of investing, through work and their IRA, through their, Robinhood account, whatever. So you can kind of see they have some of this NASDAQ, one of the most popular ETFs for that, QQQ. Total stock market index, one of the more popular ETFs out there, just for buying a big basket of stocks in the United States. Buying the S&P 500, one of the more popular ETFs for that. It's called SPY. Gold's done real well lately, and you see certain talking heads talking about it a lot. So more people have picked up gold, and that's an ETF to be able to buy that GLD. Some people at least have some. I see it less and less and less. People have been dropping the international, but they'll have like some token allocation to international. This is a popular one from an actual mutual fund from Vanguard this time. One of the more popular conservative or bond ETFs right here. PIMCO total return is in or used to be in a lot of 401ks and what's out. So you may have seen that. Of course, ARK, their main innovation fund. So you're like, I'm going to get into the new technology and get into ETF. And, then I put a couple stocks in here. I think I put P&G, Apple, and JP Morgan. So I'll see those a lot, especially Apple, when people just kind of bought it on themselves. I'll see positions like JP Morgan or Procter & Gamble when they inherited it from their dad or their aunt or something like that. And so this is, it's actually not a bad portfolio. But if you look at this graph right here just shows you this top is large companies, and this side's value, and this side's growth. And blend just means it's kind of in between, or it doesn't fall neatly into these. Since growth has done so good lately, a lot of blend is a lot closer to growth than anything else. So this is still a very growth heavy portfolio, and of course large heavy as well too. This pie graph just shows you on a very broad level how your eggs are in different baskets. So the dark blue are your stocks in the United States. The red are your international stocks or non-US. The orange are your conservative bonds, and the green is your cash. And then the other in here, in this instance, was the gold. But it could be like the things that I said, like alternatives and commodities, etc. And so you can see in this, it's like most of what they're doing is in the United States, and then most of it's in large company. And if we only look by stock, then you could see pretty much almost 90% in the United States right here. Very little internationally, and what is there is mainly in developed stuff. Okay, so not much emerging market exposure at all, and it tends to be very technology heavy. So it's like 32%, and that's really comparing to our benchmark is, combining the S&P with the small company index, with the international index, with the bond index, it's over, 30% more than the benchmark, and the benchmark's tech heavy already to begin with. Okay. And again, this is not a bad portfolio between all these different funds. It's split up into, probably 400 or 500 different stocks or what so. And so there's good diversification across, like no concentration in a specific company per se. But it is very concentrated in US and especially large US. Okay. We can look at that. Oh, of course. Yeah, let me see. Look at that. This lets us look a little bit different in terms of, let it load up here, and in terms of us being able to manipulate the time frame. While that's loading up, let me click back over here so you can kind of see the rate of return. Okay, so this one's going to be as of the end of June, so it's very up to date, and it's got, like we were talking about before, 1, 3, 5, 10 year, and it's got a since inception, but since inception only goes back to 2015. So really, it's barely different than the 10-year on here because it gets limited. The shortest rate of return was for the investments that are inside of there. And again, this is another shortfall of back testing, is that when you make a portfolio like this, it can only go back as far as the investments go back. And some of them will stop it, like this one, and some of them will continue to go back and just drop out the ones that don't have that long history, which can give you a very jaded view of how well it's done if half of your portfolio is not even being modeled when you go to a 15 or a 20-year period and you're trying to look that far back. But you look at the 10-year on that, it's great. It's 12.2%. Now, again, this is pretty much not considering that there was any other cost, besides I think it's 0.27% of like the ETFs that are in this one. So if there were other expenses like from the 401k or a financial advisor, an intermediary, or the broker charges for trading or whatever, that's not getting taken out. It's just saying kind of the gross return before any of that. Now our benchmark, which is a great benchmark, was only at 9.35. So that this large growth tilt actually helped this portfolio a good bit. Now, take it with a grain of salt. If you do investment analysis or what's out, it's easy to look at stuff that you've accumulated and how when you've done and looked at rate of return, you picked out some of the better funds in your 401k or whatever, and then you bought more of them. You didn't hold them generally the whole 10 years. You accumulated them sometime, for most people, between the 1 to 5 year period, maybe on average around 3 years. And so this is probably not indicative. Whenever you get an analysis like that, it's just taking what you have now and saying, if you held this the entire time, we go back and look and see what it would have made. But again, it's not usually right for people. And if you do have an advisor that their performance just looks so spectacular and you're just like, I don't feel like I made that much. When they run reports like this, a lot of times they pick funds that are really good, like we talked about when you're looking at these time periods, but they're doing the same thing that I try to warn investors not to do, to cherry pick investments that just look good on paper, but may not necessarily be the best investments for the next 10 years. Okay. And so that is definitely a pitfall here. So this report tells you a lot more. I know I'm running out of time. We could break it down, by sectors and countries, and what the funds are in here. Risk, you can see in this, it's like it's even got lower standard deviation than the benchmark and outperformed it. So when you were looking at like some of these more complicated multiples, they look really good, because to get better return for less risk, it just looks perfect. But again, you've got to take into consideration the market cycle you're in, and are you building a portfolio to do good the last 10 years, or would you rather do good the next 10 years? And we don't even know that the next 10 years won't look identical to this one. More than likely, that's a lower probability, but it's still a possibility, right? We don't know the future. Okay. I'll show you. Let's see if this thing loaded up. Yeah, it did. Good. So in this one, you can kind of see, it's a lot of the same data. I built it to be the same inside of this software as in the Morningstar one we were looking at. This one is from Nitrogen, as another company. It's actually one of the ones we do the analysis for you if you take advantage of our free analysis. But this helps you to see correlation. So whenever it's dark green, that means that they're going to move up and down kind of at the same time. Whenever it's blue, it means it's low, which kind of makes sense. So you can see the bond one, you see all the little blue lines going out to it to multiple different ones, is lower correlated to lots of different things in there. So that's a good choice if you're trying to get some diversification and protection inside of there. And in this one, I did, kind of their benchmark's a little bit different than the one that I like to use, but we have to kind of use theirs versus the portfolio. And then I kind of put in kind of one of our portfolios that's kind of risk adjusted close to how this portfolio is, so that we're not being more aggressive or more conservative, but it's kind of built more for the future. Like, let's buy some of the things that didn't do as well in the past, but are a good deal right now. And so this is just showing the 1 year, but if we went back and showed, like, say, the last 10 years, now it does take this thing a hot minute to update when it's trying to run all three of them and go back in history. But when you look at that, you'll see the last 10 years was really good for the large growth tech heavy portfolio here. Okay. And so it's still taking its sweet time. Come on. I want to show you a couple of these variations before. But you can see in this, because of stacking like the QQQ and the SPY, and they straight up had like 4% Apple. Now it's pushing up to 10%. 10% is a lot of any individual position. If something happened to Apple, it could really hurt this person's future or how much they could have had in retirement income or what so. And so, just a small one update, does it? Oh, there it goes. Oh, no, I moved it again. Okay, but you'll see the large growth did really good with the benchmark. The one that we've built right here hasn't done as well because it's not large growth heavy, And if we look at it, you can kind of see it's got a lot more international. It's got a lot more small and mid cap. It actually leans a little bit more towards value than to growth. And it kept up with the benchmark, pretty good. We minus our fees out of here whenever I show these. So you can kind of see that it's putting our advisory fee in there too. It doesn't look as good when you back test it. But if we are to like take this all the way back to, hopefully we can get it to update faster than last time. Always a slave to trying to do things live when it's a online thing. But when you look at this, you'll see it comes back to a lot more parity because it's a different market cycle once you start to go past 15 years than it is just the last 10 to 12 years. And even if you went 18 years, it would start to get behind before. But if you go to pre-tech bust, then even with the near-term underperformance, you end up with outperformance. So people are not really testing long-term enough on some of these things to draw the conclusions that they are, that their portfolio is superior. And being, growth or tech heavy might be something you want to do for a strategy that's appropriate for you. I wish I could get, oh, there we go. And so, again, once we keep going back farther and farther, you see how this is coming up and starting to join. Okay. And then this is only back testing the whole time. If you do have a more diversified type portfolio, you're not just going to let it ride. Sometimes when things go down, we do this all the time. If I had my portfolio manager on here and we were talking about how to actually trade and stuff, like we rebalance and buy low and sell high, and we make changes to the portfolio through it, which we try to contain a little bit of risk, and we try to buy low over time, which helps to bring some things back up for the fact that you've got more diversity inside of here from different things. So you can see now it's like 69% in the United States instead of 89. And then when we actually look at like how much is developed versus emerging markets, from 1 to 2% to like 12. Okay, and the expense ratio is actually less of the underlying funds. So this person, I don't think when you look at this, when I run into people like this is probably, typical 50 to 60-year-old, I'll see something like this. I don't think they think that this is aggressive, right? Because of how it's gone, and bonds haven't done that well the last 5 years, and they've kept more of their stocks and the things that have done well. So they wouldn't consider themselves aggressive, but they are. So they might actually even like to be a step down. Like for us, that's like moderate aggressive. Like, hey, let's take, the bonds and cash and get up to like about 30% and have more diversity inside of here. And yes, you give up some rate of return, but you get a little bit more certainty. You can sleep at night. If there's a decent recession for a longer period of time, you can withdraw from the conservative partiers without having to sell low on the stock side of it. So again, there's more to consider when you're building these things than just the absolute rate of return of making the most, right? And you've got to think about that. If you're making a decent amount of money, you got to think about taxes too, because a very tax inefficient portfolio, if you're buying and selling a lot after Uncle Sam takes their big chunk out, especially if they end up raising capital gains and whatso, can, take a big bite out of your rate of return. So I've hit on a lot of these things, a balanced portfolio. And again, you could be aggressive, you can be conservative, you can be anywhere in the middle. You can even be speculative and still build these things better from a risk adjusted point of view to where you can deliver superior risk adjusted results. Okay. There's always usually going to be somebody that beats you. Because they concentrated or they leveraged or they made a gamble to put everything into like one egg in a basket and they hit it. But if they do that enough times over time, they statistically will not be able to do that, and they will not do as well as you. And so the real crux of this is you want to get rich slow to a certain degree for sure, not get rich fast and have a decent probability of losing everything, or somewhere in the middle, right? You want to have a high probability of doing well and letting that exponential growth grow for you. So don't predict the future. You just need to prepare for it. Build a better system, build a better portfolio. If you're not sure what that is, find someone like us that will help you, either on an ongoing basis, or like I said, just take advantage of our free portfolio analysis. We do that to build bridges and help people. And over time, we do find that eventually people do want to partner. And we're there when people are ready. We even have a free version of our software to just use some of the stuff and our organizational portal and aggregation, etc. So check out our reviews, all the things that we do. We got a spectacular team. We really do care about people. This is our team right here. If you're doing the free investment analysis, Franco will generally be helping you with that. And if you're happy enough to where you're just like, what other alpha, remember we talked about that, can you help me with in terms of financial planning, retirement planning, estate planning, taxes, then you'll start to work with our other team members that are advisors, coaches, accountants, etc. You could schedule a complimentary appointment if you want. But again, we do these just so you can learn as well. I hope that I got to answer most of your questions as we went. Best of luck to all of you out there being able to save up and invest in our market economies that hopefully are good for all of us, not just the richest of people out there, is a wonderful opportunity. And I hope that you do it well. I hope this helps you. If there's any questions, send it to me. If you weren't on the live version of this, if you do have questions, it comes to my inbox. I will generally respond to and still answer your questions. So thanks so much for joining us. Join us next week. We're going to do our part 2 of using AI to help with your wealth, investment planning, know-how, and protecting yourself. Join us for that. It's going to be another good one. And if you are doing that and you didn't watch the first one, that is on replay. Go ahead and watch that one just so you have the primer, because I'm going to start off right where I left on that last one. So have a great rest of the week. Thanks for joining us again. And hopefully we will see you on one of our future webinars. See you then. Bye-bye.